Okay, let's jump right in. We are going to break down how the stock market actually works. We're talking about what you're really buying, what in the world an IPO is, the truth about day trading, and yeah, how fortunes are made and lost. The goal here is simple, to make sense of a system that often feels like it's designed to be confusing.
And isn't that the truth? It really can feel like there's this secret language everyone else is in on. You hear about it on the news, you see it in movies, but the actual mechanics, it can feel like a total black box. Well, today, we're going to open that box. So here's the deal. By the time we're done here, you're going to have a real, solid understanding of this system. Not just the buzzwords, but the actual logic that makes the whole thing tick. All right, let's start at square one. The most fundamental piece of this entire world, the stock itself. When you click buy on a stock, what are you actually getting? It's really that simple. A stock is just a tiny, tiny slice of ownership in a business. You know, if a company has 1 million shares out there and you buy one, you now own 1/1,000,000th of that entire company. The buildings, the brand, its future, you own a piece of it all. So a stock is really three things all at once. First, it's ownership. The company does well, you do well. Simple. Second, it's belief. The price you see is basically a real-time poll of what millions of people think that company's future is worth. And finally, yeah, it's risk. If that belief fades or the company stumbles, you feel that too.
Okay, so that's a single stock. Now let's zoom out a bit. Where do these stocks even come from? How does a company go from just being a private idea to a name you see scrolling across the bottom of your screen?
You know, before a company is on the stock market, it's private. Think about brands we all know, like Lego or Trader Joe's. They're owned by a small group of people, founders, maybe a family. They call all the shots and keep their finances to themselves. A public company, on the other hand, like Tesla or Nvidia, has sold off pieces of itself to, well, us, the public. And that means they have to answer to thousands of owners, the shareholders, and open their books for everyone to see. So, how does that switch happen? It's all about something called an IPO, or initial public offering. Companies do this to raise a ton of money for growth or to get a big dose of credibility. It's this huge moment where, for the very first time, they offer shares on a public stock exchange, like the NYSE or NASDAQ, and anyone can buy a piece.
Now, once that stock is public, it's bought and sold during specific hours. The main event, the big show, is from 9:30 a.m. to 4 p.m. Eastern Time. But there's also trading that happens before the market opens and after it closes. Just be aware those after-hour sessions are way more volatile. We're talking wild price swings because there are just fewer people trading.
And it's not just stocks of single companies you can trade. You've got things like ETFs, which are basically bundles of different stocks all packaged together. Then there are index funds, which are kind of similar, but they're built to just copy a whole market index like the S&P 500. And then you get into the really complex stuff like options and futures. For most people just starting out, though, sticking to stocks, ETFs, and index funds is a much simpler way to go. Okay, let's zoom in on something you've definitely heard about, and it's often misunderstood. Day trading. This is the fast lane of the market. High speed, high stakes. Day trading is literally what it sounds like. You're buying and selling a stock on the same day, sometimes just minutes or seconds apart. The goal isn't some long-term bet on the company. Nope. It's all about making a tiny profit from a tiny, quick price jump. And it has absolutely exploded in popularity thanks to slick mobile apps and all that social media hype about getting rich quick. Now, this is really important to know. In the US, if you start making a bunch of day trades, you get officially labeled a pattern day trader. And the rules say you have to keep a minimum of $25,000 in your account. That rule is there for a reason. It's basically a barrier to make sure people aren't taking on this incredibly high risk without some serious capital to back it up. And make no mistake, it is a high-risk, high-stress world. The chance for quick profits is always there, but so is the risk of huge, fast losses. You have total control, which is great, but it comes with a ton of emotional stress, and it can easily turn into a full-time job. This is not some passive, easy money thing. And here it is. This might be the most important number to remember about day trading. Study after study shows the same stark reality. Over time, something like 95% of individual day traders lose money. Why? Well, they're up against huge firms with supercomputers. Trading fees chip away at their small gains, and making emotional, split-second decisions is just a recipe for mistakes. The odds are just not in your favor.
So whether you're in it for a minute or for a decade, it all comes down to the price. But what actually makes those prices go up and down every single second of the day? Let's look at the forces behind the numbers. A stock's price is getting pushed and pulled by a whole mix of things. You've got the company's actual performance. Are they making money? Then you've got news, world events, and of course, basic human psychology, that constant tug of war between fear and greed. It's also just simple supply and demand, and bigger things like interest rates can have a huge effect. Then there's pure hype. I mean, look at a company like Nvidia and the AI boom. That's a perfect storm of amazing performance, huge news, and just incredible investor excitement. When you boil it all down, it comes to this. A stock price is just a measurement of our collective belief in a company's future. When belief is high, the price goes up. When fear and uncertainty take over, the price goes down. And if a company actually goes bankrupt, that belief disappears and the stock can become worthless. It can go to zero, but your loss is capped at what you paid. All right, let's shift gears completely. Let's move away from the chaotic world of day trading and talk about the strategy that has historically worked for most people: long-term investing. This is all about building wealth slowly, patiently, over time. You know, here's a good way to think about it. On one end of the spectrum, you have hedge funds. They're super aggressive, use really complex strategies, have high fees, and are mostly for the super wealthy. On the total opposite end, you have an index fund. It's simple, it's predictable, it has super low fees, it's not trying to be a hero and beat the market, it's just trying to be the market. For most of us, this is a much more reliable path. And here's one of the biggest hidden perks of thinking long-term: taxes. So when you sell a stock for a profit, that's called a capital gain. If you owned that stock for less than a year, you get taxed on that profit at your normal higher income tax rate. But if you hold it for more than a year, you qualify for a much, much lower tax rate. The whole system is basically set up to reward you for being patient. Okay, so we've covered a lot. Knowing all this, what does a smart, simple plan actually look like? Let's wrap up with a few of the most important habits for success. Rule number one, the absolute most critical habit, is diversification. It's just a fancy way of saying don't put all your eggs in one basket. Spreading your money out across different things, index funds, a few stocks, maybe some ETFs, protects you if one area has a really bad year. And a few other key habits. Only invest in businesses you actually understand. Try to avoid making big decisions based on fear or hype. And seriously, stop checking your portfolio every 5 minutes. This question right here, this gets to the absolute core of smart investing. We know the market can be a roller coaster in the short term. So, what's the right answer? And the answer is a huge, resounding no. You should never, ever invest money that you think you might need in the next couple of years. The market needs time to ride out the bumps. The single most powerful tool you have as an investor is time. That is the foundation of everything. So let's end by rethinking what this all is. It is so easy to see the flashing red and green numbers and think it's just a giant casino. But it's not. It's a system for directing money toward growing companies. And it runs on 3 things: collective belief, information, and above all else, time. You don't need to be a genius or a gambler to succeed here. You just need what you have now: some clarity on how it all works, the patience to let time do its thing, and a basic plan to guide you. And that is how the stock market really works.